It is that special time of year again. No, not Christmas. It is the annual review of estimates. The day we must admit that we have absolutely no idea what we are doing. Here's the reality. When you bought that machine, you guessed it would last 10 years. That was a lie. You made it up. Now, IAS 16 forces you to look at that machine every single year and ask, are you still okay? If Bob the intern has been kicking it every day, it is not going to last 10 years. It is going to last 2. You have to update the useful life and the residual value. And listen to me carefully, because this is where people get fired. This is a change in accounting estimate, not an error. You do not go back and fix the past years. We do not have a time machine. You fix it prospectively. That means you take the remaining book value and spread it over the new remaining life. You are basically telling the shareholders, whoops, we were wrong, but we will fix it from now on. If I catch you restating retained earnings because you changed your mind about a truck's life, I will depreciate you. We have reached the end. Derecognition. The accounting term for get this junk out of my sight. This is the breakup conversation of the asset lifecycle. It is time to tell that old machine, we have grown apart. I met a newer, faster model on Amazon. Here's the math. And it's the only time you might feel joy. You take the net disposal proceeds and you subtract the carrying amount. That difference? That is your gain or loss on disposal. But listen to me. If you sell your old delivery truck, that cash is not revenue. Do not put it on the top line. You are not a used car dealership. It goes in other income. If I see you padding your revenue numbers with asset sales just to hit your sales targets, that is not accounting. That is a Ponzi scheme. And if you just throw the asset in the dumpster, that is a disposal with zero proceeds. That means you write off the remaining value as a loss. Painful? Yes. But keeping a zombie asset on the balance sheet that doesn't exist anymore? That is lying. Bury the dead, book the loss, and move on. You think we're done? Ha! You wish. We missed the most dangerous part. What actually goes into the cost of the asset? This is where you people get creative, and I have to get violent. Here's the rule. You can capitalize the purchase price, import duties, and directly attributable costs to get the asset ready to work. Shipping? Yes. Installation? Yes. Site preparation? Yes, but here's the trap, and I see you reaching for the pen. Do not capitalize training costs. I don't care if you spent $1 million teaching the staff how to use the new robot. You cannot capitalize training. Why? Because staff can quit. You don't own them. Well, legally you don't. If Gary walks out the door, the knowledge leaves with him. You cannot put Gary's brain on the balance sheet. And don't forget dismantling costs. If you have to destroy the planet to install a factory, you have to pay to fix it later. You have to estimate that cost today, discount it, and add it to the asset price. It's like booking the cost of your divorce before the wedding even starts.